Hi, Souls Trader here. Today I'm going to be talking about some mistakes traders make, especially in the beginning of their trading journey. If you haven't noticed already, I'm going to be illustrating some of these mistakes in a dino suit because literally why not? Let's have some fun here. In all seriousness, I'm not trying to be gimmicky or anything with the dino suit. I'm just attempting to add a little humor to my mistakes where I more or less felt like a dumb T-Rex with tiny arms once I fully understood what I had done. The first mistake I want to discuss is using the wrong trading strategy for I guess what you could call the right idea. What do I mean by this? Well, let's take a look at a trade I made on AMC in 2021. Sometime after the AMC short squeeze of 2021, I was convinced AMC had topped out. I believe at the time AMC was trading between $50 and $60 a share. I knew I wanted to short it, but I also knew it could take a while to come back to earth or even go up again before declining further. I wanted July 2022 puts, but in the money puts premium were really expensive. I settled on, for lack of better words, July 2022 $10 puts for $3 a contract. The first problem with this trade is break-even point at expiration for those contracts would mean AMC would need to be $7 or less at expiration. I didn't think it would go that low by then, but I figured I would close the contracts before expiration anyways on a good red day. Even though AMC did end up declining substantially during the life of the contract, it wasn't enough to keep up with beta decay. AMC basically trickled down somewhat slowly over the life of my contract. There was so little demand for that deep out of the money put contract that there were days where AMC stock was down 5-10% and the premium still didn't budge or even declined slightly. So while I was right from a fundamental sense that AMC would decline substantially over the next year, using the wrong strategy caused me to lose money. What I learned from this mistake is that choosing the right strategy matters just as much as choosing the right direction of a stock price when placing trades. Choosing the wrong strategy for the right trade is like someone trying to eat soup with a slotted spoon. You have the right idea, but with the slotted spoon, you're going to lose out on the soup, the gains. The second trading mistake I want to discuss is basing your trades solely for tax purposes. To be clear, I do think tax management is part of any profitable portfolio, but trading solely for tax purposes and no other reason can do more harm than good in some cases. For example, towards the end of the year, some traders do what's called tax loss harvesting. This is when you close losing positions, typically to lower taxes on profits. And depending on your situation, this can be beneficial. However, one issue that can arise from this is it could cause you to hold on to deeper losses by waiting to close a loser at the end of the year versus closing the losing position earlier. To clarify, not every losing trade is worth holding until the end of the year because, it's a write-off. This next point may not be that big of an issue for traders since we typically don't hold on to positions for that long, but a mistake that could be made is holding on to a winning trade because of being afraid of short-term capital gains tax. It's one thing to be very bullish on a stock and choose to hold on to it longer, but it may not always be wise to risk unrealized gains just because you want to lower your taxes into long-term capital gains. In a couple months, you may be lowering your tax bill, sure, but it may not be in the way you want with losses instead of long-term capital gains. When it comes to taxes, it's always best to ask the professionals so they can look at your situation and give you the best routes to take. In the past, I've consulted with tax professionals that actually specialize in taxes for traders. Even though their hourly consultation rates can get pricey, usually it's at least worth it every couple years to know you're making the best financial decisions for yourself. And, for me, I prefer to base my trades more on market data versus potential taxes. I just kind of look at it as like taxes are guaranteed, right? But profits or fixed losses may not be. I like to take profits and losses when the charts tell me to, not so much when the IRS does. The third mistake piggybacks on the second mistake, especially when it comes to tax loss harvesting. I think most traders get hounded by the basics of the wash sale rule in pretty much all beginning trading content. But I think where a lot of the mistakes can happen is in the gray areas of the rule. And that's because not only can you not rebuy the same security after 30 days of realizing a loss, that is, if you want to keep the tax benefits of the loss, you also can't turn around and buy a security that is the same or substantially similar. There's no real guidelines on what counts as substantially similar, but it's an easy mistake to make when you're trading ETFs and indexes of the same sector. And technically, it's not just a 30-day window after the loss you need to be conscious of. You also can't write off a loss if you bought a substantially similar security 30 days prior. You also can't try to skirt around the rule by using multiple accounts or your spouse's account. The wash sale rule gets even more vague when it comes to options. I need to dig deeper into it, but from what I understand, a wash sale can also apply to substantially similar options, even with different expirations. If you do end up with a wash sale, it's not the end of the world. Those losses typically get deferred into your next trade that was substantially similar. In summary, the real problem can happen when you try to claim losses, say at the end of the year, then try to buy the same security back under 30 days in the next calendar year. You could end up with an unexpected tax burden the next time you do your taxes, so just be wary of that. Mistake number 4 is beating yourself up over trading losses. I know I said that all these mistakes made me feel like a big dumb dinosaur, but seriously, doing your best to keep your emotions and mental health in check is crucial for success as a trader. Some losses and trading mistakes may require a break, and that's normal, but beating yourself up and dragging down your morale just sets you up for revenge and emotional trading, which could cause you to lose even more money. Trust me, I have been there so many times. I know it can feel like a constant battle, and especially in a volatile bear market. The 5th and final mistake I want to go over is not fully understanding pattern day trading rules. And that rule is you basically can't make more than 3 day trades in a 5-day trading window unless your account is above $25,000. The first time I got hit was I had a couple of limit orders open. One SPY contract didn't fill before the closing bell, so I didn't bother to cancel it. Turns out SPY contracts can fill 15 minutes after the closing bell. So that contract I didn't cancel ended up filling after hours, and because I'd been swinging that particular contract a few times, I got flagged. The second time I got hit was because I placed several day trades when my account was over 25K. Now, that's not a problem. However, the next trading day, I didn't make any new day trades, but my account fell below 25K. I thought my other day trades were exempt from the rule since those day trades were made when my account was above 25K and closed above 25K. But no, the 25K rule applies across all 5 trading days. You can't make a bunch of day trades on, say, day 1 when your account is above 25K if on day 2 your account falls below 25K and markets close with your account below 25K. Even though you didn't make any new day trades on day 2, you'll get dinged unless you deposit money before the end of the day to keep your account above 25K and to keep your older trades exempt from day trading rules. Last I checked, Robinhood doesn't go into a lot of details other than specific trades that can get you flagged as a pattern trader. On that note, I learned not to rely solely on beginning trading platforms like Robinhood when it comes to trading regs. They might explain the gist of the reg, but you could be missing out on more advanced information.